Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Understanding Business 2024, Chapter 20, narrated by Omar Mohsen Ibrahim Fouad. Chapter 20, Money, Financial Institutions, and the Federal Reserve, page 531. Learning Objectives. After you have read and studied this chapter, you should be able to explain what money is and what makes money useful. Describe how the Federal Reserve controls the money supply. Trace the history of banking and the Federal Reserve System. Classify the various institutions in the U.S. banking system. Briefly trace the causes of the banking crisis of 2008. And explain how the government protects your funds during such crisis. Describe how technology helps make banking more efficient. Evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. Page 532. Getting to know Jerome J. Powell, Chair of the Federal Reserve. The Federal Reserve, the Fed, is the central banking system of the United States. It is the agency in charge of the nation's monetary policy, as well as the money supply and interest rates, which keeps its actions very much in the public eye. Jerome J. Powell became chair of the Federal Reserve in 2018 after replacing Janet Yellen, the first woman to hold the position in the Fed's 100-year history, along with being the wealthiest member of the Federal Reserve. Powell is also the first Fed chair in more than 40 years who does not have a degree in economics. Powell grew up with his brother and 4 sisters in Washington, D.C., the son of a lawyer. After graduating from Princeton University with a bachelor's degree in politics, he decided to follow in his father's footsteps and study law. He earned a law degree from Georgetown University, where he was also editor-in-chief of the Georgetown Law Journal. Powell then worked as a clerk for a federal appeals court judge before joining a major New York law firm. After a few years, though, Powell decided his father's career was not for him. So in 1984, he changed course and joined an investment banking firm. Powell moved back to Washington in 1990 to become Undersecretary for Domestic Finance in President George H.W. Bush's Treasury. Powell moved back to Washington in 1990 to become Undersecretary for Domestic Finance in President George H.W. Bush's Treasury Department. Besides overseeing policy on financial institutions and the Treasury debt market, he also assumed responsibility for untangling a series of bank failures. Following President Bush's re-election defeat in 1993, Powell returned to New York City and continued his banking career. In 1997, he again moved back to Washington and joined the Carlyle Group, a private equity investment firm. His time spent at Carlyle proved to be very lucrative, sending Powell's net worth skyrocketing into the tens of millions. After spending years in the banking industry, Powell was eager to return to the public sector. He left Carlyle in 2005 to focus on public policy as a scholar at the Bipartisan Policy Center in Washington. While at the organization, he focused his research on federal and state fiscal matters and refused to take a salary. In 2011, Powell caught the eye of then Treasury Secretary Timothy Geithner, who recommended him to President Obama for appointment to the Federal Reserve. His nomination was approved by the Senate in 2012, followed 6 years later by his appointment to Fed chair. Powell was renominated for a second term as Fed chair in 2002. Colleagues describe him as an able collaborator who prefers to keep a low public profile. With the onset of the COVID-19 pandemic, however, Powell was put squarely in the public eye as he acted as a key spokesperson for the government's response to the crisis. Under his leadership, the Fed first slashed interest rates, but later raised them in an effort to curb rampant inflation. This controversial move has ensured that Powell's role in developing economic policy is more prominent than ever. You will learn more about money, the Federal Reserve, and the banking system in this chapter. Using that information, you can better understand key decisions involving monetary policy, interest rates, and unemployment. By reading this chapter, reading business publications, and listening to business reports, you can understand how the Fed's policy impact the U.S. economy. Sources: Nick Timiraos, March 2020, How the Fed Averted Economic Disaster. The Wall Street Journal, February 19, 2022. Rich Miller, Powell's Fed is set to attempt a rare soft landing in the fog of war, no less. Bloomberg, Bloomberg.com, March 9, 2022. Gianna Smalek, How the Fed Opened Pandora's Box. The New York Times, NewYorkTimes.com, February 25, 2023. Nick Timiraos, latest Fed increase came down to the wire. That was a rough weekend. The Wall Street Journal, WSJ.com, April 6, 2023. Brendan McDermott, Alamy Stock Photo. Brendan McDermott and Alamy Stock Photo, page 553. Name that company. This financial institution was established after World War II to assist in the rebuilding of Europe after the devastation of the war. Today, its primary role is to lend money to less developed nations to help raise productivity and improve the standard of living and quality of life. It also is involved with eliminating diseases and income inequality and taming rampant inflation in less developed. Name that company. You can find the answer in this chapter. Why money is important. LO 20-1. Explain what money is and what makes money useful. The Federal Reserve, or the Fed, is the organization in charge of money in the United States. You've probably heard about the Fed and its actions during the COVID-19 pandemic and the battle with inflation in 2023. Perhaps you are familiar with its current chair, Jay Powell. That is why we chose Powell to be the subject of a getting to know feature for this chapter. Once you have some understanding of the Federal Reserve, our goal in this chapter is to introduce you to the world of banking. Two of the most critical issues in the United States, economic growth and the job. Two of the most critical issues in the United States, economic growth and the creation of jobs, depend on the ready availability of money. Money is so important to the economy that many institutions have evolved to manage it and make it available when you need it. Today you can get cash from an automated teller machine, ATM, almost anywhere in the world, and most organizations will. Today you can get cash from an automated teller machine, ATM, almost anywhere in the world, and most organizations will also accept a check, credit card, debit card, or smart card for purchases. Some businesses will even accept Bitcoin, a digital version of money referred to as a cryptocurrency. Behind the scenes is a complex system of banking that makes the free flow of money possible. Each day, trillions are exchanged in the world's currency markets. Therefore, what happens to any major country's economy has an effect on the U.S. economy and vice versa. Let's start at the beginning by discussing exactly what the word money means and how the supply of money affects the prices you pay for goods and services. What is money? Money is anything people generally accept as payment for goods and services. In the past, objects as diverse as salt, feathers, fur pelts, stones, rare shells, tea, and horses have served as money. In fact, until the 1880s, cowrie shells were used as one of the world's currencies. Bureau of Engraving and Printing, U.S. Department of Treasury. Newer engraved bills makes counterfeiting much more difficult than in the past. The current bills look a little different than older ones and contain a variety of colors. If you owned a store, what would you do to make sure employees wouldn't accept counterfeit bills? Page 534. Barter is the direct trading of goods or services for other goods or services. Though barter may sound like something from the past, many people have discovered the benefits of bartering online. One entrepreneur describes his bartering experience as follows. Last year, we bartered the creation of a full-color graphic novel in exchange for a new website design. The value of the trade was $50,000. We provided 3 months of writing services to provide the graphic novel storyline, and then 5 months of illustration. In exchange, they helped us to define, design, and then program our new website. Gustavo Andrade and iStock and Getty Images Plus and Getty Images. Although people have long used barter to exchange goods without money, one problem is that products like chickens and eggs are harder to carry around than a $10 bill. What other drawbacks does bartering have? Some people barter goods and services the old-fashioned way. In Siberia, for example, people have bought movie tickets with 2 eggs, and in Greece, vegetables have been exchanged for English lessons. Today, you can go to a barter exchange where you can put goods or services into the system and get trade credits for other goods and services that you need. The barter exchange makes it easier to barter because you don't have to find people with whom to barter. The exchange does that for you. The problem with traditional barter is that eggs and vegetables are difficult to carry around. Most people need some object that's portable, divisible, durable, and stable so that they can trade goods and services without carrying the actual goods around with them. One solution is coins and paper bills. The 5 standards for a useful form of money are portability. Coins and paper money are a lot easier to take to market than pigs, eggs, milk, or other heavy products. Divisibility. Different sized coins and bills can represent different values. Prior to 1963, a U.S. quarter had half as much silver content as a $50 coin, and a dollar had 4 times the silver of a quarter. Because silver is now too expensive, today's coins are made of other metals, but the accepted values remain. Stability. When everybody agrees on the value of coins, the value of money is relatively stable. In fact, U.S. money has become so stable that much of the world has used the U.S. dollar as the measure of value. If the value of the dollar fluctuates too rapidly, the world may turn to some other form of money for the measure of value. Durability. Coins last for thousands of years, even when they've sunk to the bottom of the ocean. As you've seen when divers find old coins in sunken ships. Uniqueness. It's hard to counterfeit or copy elaborately designed and minted coins. With the latest copiers, people could duplicate the look of paper money relatively easily. Thus, the government has had to go to extra lengths to make sure real dollars are readily identifiable. That's why we have paper money with the picture slightly off center and with invisible lines that quickly show up when reviewed by banks and stores. On the $100 bill, for example, Ben Franklin shares space with colorful illustrations, hidden text, and pictographs that reveal themselves only when they are lit from behind or exposed to ultraviolet light. Coins and paper money simplified exchanges. Coins and paper money simplified exchanges. Most countries have their own currencies, and they're all about equally portable, divisible, and durable. However, they're not always equally stable. Electronic money, e-money, is a newer form of money. You can make online payments using PayPal, Google Pay, or your bank's website or app. You can use Apple Pay on your iPhone to pay in brick and mortar stores. Cryptocurrencies like Bitcoin are digital versions of money that use Cryptocurrencies like Bitcoin are digital versions of money that use cryptography for security, making it tougher to forge, easier to cut across international boundaries, and able to be stored on your hard drive instead of in a bank. However, Bitcoin, which was launched in 2009, is not yet generally accepted. The collapse of FTX, one of the largest and busiest platforms for trading cryptocurrency, also brought a wave of uncertainty and questions about the crypto market. Nonetheless, efforts will likely continue to be made to create a cashless society using some other form of currency than the bills and coins we use now. Page 535. Reaching beyond our borders. If the currency doesn't work, print your own. If you are lucky enough to have a US $100 bill in your pocket, you probably feel pretty good. The $100 bill is the largest US bill in circulation since the $500, $1,000, and $5,000 bills were axed in 1969. Well, think how you would feel if you had a $100 trillion bill, that's right, we said trillion, in your pocket. Zimbabwe is the country that brought the world a $100 trillion bill in the early 2000s. The $100 trillion bill was an outgrowth of the government's effort to print more money due to a total collapse in the nation's agricultural production caused by a controversial land redistribution effort. 1 month, inflation peaked at 78.6 million%. Needless to say, things unfortunately didn't work for the nation's economy then. And today, Zimbabwe seems to have reached a complete level of monetary dysfunction. In 2009, the government abolished the Zimbabwe currency and began using US dollars instead. This monetary shift provided a few years of relative economic stability. However, in 2019, the government reintroduced the Zimbabwe dollar as the nation's official currency. Today, it takes over 900 Zimbabwean dollars for a US $1, and inflation is running at close to 230% a month. Businesses want only US dollars, and Zimbabwean workers want their wages converted to US dollars. Zimbabwe's commercial banks and its central bank import US $1 bills for local use. But here is where the complication comes into play. The cost of importing the low-value currency is very high, and uneconomical due to its heavy weight and low value. The imbalance has caused a shortage of US $1 bills. the most widely used bills in the country. This has reinforced merchants in Zimbabwe to take things into their own hands. Siempreverde 22 and iStock and Getty Images Plus and Getty Images. If you go to a local fast food restaurant in Zimbabwe's capital city, Harare, and order a sandwich, fries, and a drink, then offer a $5 US bill for payment, don't look for a $1 bill and 2/4 change. Instead, you'll be given slips of paper bearing the name of the restaurant and the amount of money you have available next time you come in for a meal. Because of the lack of available small change, businesses have begun printing their own money in the form of paper vouchers. Some customers have even accepted food rather than paper sheets. As you might suspect, multiple problems make this system ineffective. You can't exchange food vouchers for bus fare. Also, make sure to empty your pockets before you wash your clothes, because paper vouchers lack the stability of currency. Your money may literally go down the drain. Sources: Gabrielle Steinhauser and Bernard Mipofu. If a $100 trillion bill doesn't work, how about some cheese? The Wall Street Journal, March 24, 2023. Chinedu Okofor, 10 African nations with the highest inflation rates in 2023. Business Insider Africa, africa.businessinsider.com, March 16, 2023. Joe Groves, What is Inflation and How Does It Destroy Your Money? Forbes, March 22nd, 2023. While no one knows when and what cryptocurrencies will succeed, no one can be sure of the future of our coins and currency either. The U.S. Mint has examined different metals and alloys to bring down the production costs of the nickel, dime, and quarter. It now costs 2.7 cents to make a penny and 10.52 cents to make a nickel. Someday, you may find that your nickels are lighter and a different color. The Reaching Beyond Our Borders box discusses a situation where money has so little value, merchants print their own form of currency. Page 536. LO 20-2. Describe how the Federal Reserve controls the money supply. The Federal Reserve is in control of the U.S. money supply. Two questions emerge from that sentence. What is the money supply? Why does it need to be controlled? The money supply is the amount of money the Federal Reserve makes available for people to buy goods and services. And yes, the Federal Reserve, in tandem with the U.S. Treasury, can create more money if it is needed. For example, the trillions of dollars that were printed due to the COVID-19 pandemic to keep the economy moving were printed with authorization from the Federal Reserve. The term quantitative easing was used quite a bit. Quantitative easing, QE, means that the Fed can create more money by buying bonds when it believes that money is needed to get the economy moving again. As the economy continued to come back, the Fed cut back on the creation of new money, with inflation getting out of control in 2023. The Fed began to tighten the supply of money into the economy to attempt to slow inflation. There are several ways of referring to the U.S. money supply. They're called M1, M2, and M3. The M stands for money, and the 1, 2, and 3 stand for different definitions of the money supply. M1 includes coins and paper bills, money that's available by writing checks, demand deposits and share drafts, and money held in traveler's checks, that is, money that can be accessed quickly and easily, M2 includes everything in M1 plus money and savings accounts, money market accounts, mutual funds, certificates of deposit, and the like, that is, money that may take a little more time to obtain than coins and paper bills. M2 is the most commonly used definition of money. M3 is M2 plus big deposits like institutional money, market funds, managing inflation, and the money supply. Imagine what would happen if governments, or in the case of the United States, the Federal Reserve, a non-governmental organization, were to generate twice as much money as exists now. There would be twice as much money available, but still the same amount of goods and services. What would happen to prices? Hint, remember the laws of supply and demand from Chapter 2. Prices would go up because more people would try to buy goods and services with their money and bid up the prices to get what they wanted. This rise in prices is called inflation, which some people call too much money chasing too few goods. Then think about the opposite. What would happen if the Fed took money out of the economy or put less money in? Prices would go down because there would be an oversupply of goods and services compared to the money available to buy them. This decrease in prices is called deflation. Now, we come to our second question about the money supply. Why does it need to be controlled? The reason is that doing so allows us to manage somewhat the prices of goods and services. The size of the money supply can also affect employment and economic growth or decline. That's why the Federal Reserve's role in the U.S. economy of keeping unemployment down and stabilizing prices is important. At this point, it is good for you to know that the global money supply is controlled by central banks like the Federal Reserve. What central banks like the Federal Reserve do clearly affects the economies of the world. For example, the European Central Bank, ECB, also enacted quantitative easing, increasing the money supply to combat economic slowdowns that occurred due to the COVID-19 pandemic that plagued Europe. The global exchange of money. A falling dollar value means that the money of the goods and services you can buy with a dollar in global markets decreases. A rising dollar value means that the amount of goods and services you can buy with a dollar goes up. Thus, the price in euros you pay for a German car will be lower if the US dollar rises relative to the euro. However, if the euro rises relative to the dollar, the cost of cars from Germany will go up, and U.S. consumers will pay more or may buy fewer German cars. Page 537. What makes the dollar weak, falling value, or strong, rising value is the position of the U.S. economy relative to other economies. When the economy is strong, the demand for dollars is high, and the value of the dollar rises. When the economy is perceived as weakening, however, the demand for dollars declines and the value of the dollar falls. The value of the dollar thus depends on a relatively strong economy. See Chapter 3 for further discussion of the effects of changes in currency values or exchange rates. In the following section, we'll discuss in more detail the money supply and how it's managed. Then we'll explore the U.S. banking system and how it lends money to businesses and individuals like you and me. Control of the money supply. Theoretically, with the proper monetary policy in place to control the money supply, one can keep the economy growing without causing inflation. See Chapter 2 to review monetary policy. Again, the Federal Reserve is the organization in charge of monetary policy. Basics about the Federal Reserve. The Federal Reserve System consists of 5 major parts. Figure 20.1. 1. The Board of Governors. 2. The Federal Open Market Committee, FOMC. 3. 12 Federal Reserve Banks. 4. 3 advisory councils. And 5. The member banks of the system shows where the 12 Federal Reserve banks are located. You should know that the Federal Reserve is not a part of the U.S. government, despite its name. It's a private firm not supported by taxpayer dollars. Figure 20.1. The Federal Reserve District Banks. The Board of Governors administers and supervises the 12 Federal Reserve Banks. The 7 members of the board are appointed by the President of the United States and confirmed by the Senate. The board's primary function is to set monetary policy. Again, see Chapter 2. The Federal Open Market Committee, FOMC, has 12 voting members and is the policy-making body. The committee is made up of the 7-member Board of Governors plus the President of the United. The committee is made up of the 7-member Board of Governors plus the President of the New York Reserve Bank and 4 members who rotate in from the other reserve banks. The advisory councils represent the various banking districts, consumers, and member institutions, including banks, savings and loan institutions, and credit unions. They offer suggestions to the board and to the FOMC. Page 538.
Page 538. The Fed buys and sells foreign currencies, regulates various types of credit, supervises banks, and collects data on the money supply and other economic activity. As part of monetary policy, the Fed determines the reserve requirement, that is, the level of reserve funds all financial institutions must keep at one of the 12 Federal Reserve Banks. It buys and sells government securities in an open market. It buys and sells government securities in open market operations. Finally, it lends money to member banks at an interest rate called the discount rate. As noted, the 3 basic tools the Fed uses to manage the money supply are reserve requirements, open market operations, and the discount rate. See Figure 20.2. Let's explore how it administers each. Note how each move the Fed makes can impact the economy. Figure 20.2, how the Federal Reserve controls the money supply. Reserve requirements. Control method, immediate result, long-term effect. A, increase. Control method, A, increase. Immediate result, banks put more money into the Fed, reducing the money supply. Thus, there is less money available to lend to customers. Long-term effect, economy slows. Control method B, decrease. Immediate result, bank puts less money into the Fed, increasing the money supply. Thus, there is more money available to lend to customers. Long-term effect, economy speeds up. Open market operations. Control method, immediate result, long-term effect. Control method A, Fed sells bonds. Immediate result, money flows from the economy to the Fed. Long-term effect, economy slows. Control method B, Fed buys bonds. Immediate result, money flows into the economy from the Fed. Long-term effect, economy speeds up. Managing the discount rate. Control method, immediate result, long-term effect. Control method A, rate increases. Immediate result, bank borrows less money from the Fed. Thus, there is less money to lend. Long-term effect, economy slows. Control method B, rate decreases. Immediate result, bank borrows more money from the Fed. Thus, there is less money to lend. Long-term effect, economy speeds up. The reserve requirement. The reserve requirement is a percentage of commercial banks' checking and savings accounts they must keep in the bank as cash in the vault or in a non-interest bearing deposit at the local Federal Reserve District Bank. The reserve requirement is one of the Fed's tools. When it increases the reserve requirement, money becomes scarcer, which in the long run tends to reduce inflation. For instance, if Omaha Security Bank holds deposits of $100 million and the reserve requirement is, say 10%, then the bank must keep $10 million on reserve. If the Fed were to increase the reserve requirement to 11%, then the bank would have to put an additional $1 million on reserve, reducing the amount it could lend out. Since this increase in the reserve requirement would affect all banks, all the money supply would reduce. Since this increase in the reserve requirement would affect all banks, the money supply would be reduced and prices would likely fall. McGraw-Hill Connect. I see it. Need help understanding how the Federal Reserve tries to stabilize the economy? Click on the video for a brief animated explanation. A decrease of the reserve requirement, in contrast, increases the funds available to banks for loans so they can make more loans and money tends to become more readily available. An increase in the money supply can stimulate the economy to achieve higher growth rates, but it can also create inflationary pressures. That is, the prices of goods and services may go up. Can you see why the Fed may want to decrease the reserve requirement when the economy is in a recession? Can you also see the danger of inflation? Page 539. Open market operations. Open market operations consist of the buying and selling of government bonds, U.S. Treasuries. To decrease the money supply, the federal government sells U.S. government bonds to the public. The money it gets as payment is no longer in circulation, decreasing the money supply. If the Fed wants to increase the money supply, it buys government bonds back from individuals, corporations, and organizations that are willing to sell. The money the Fed pays for these securities enters circulation, increasing the money supply. That's why during the Great Recession of 2008 and the COVID-19 pandemic, the Fed bought bonds in an attempt to get the economy growing again. The discount rate. The Fed has often been called the banker's bank because members can borrow money from the Fed and pass it on to their customers in the form of loans. The discount rate is the interest rate of the Fed. The discount rate is the interest rate the Fed charges for loans to member banks. An increase in the discount rate discourages banks from borrowing and reducing. An increase in the discount rate discourages banks from borrowing and reduces the number of available loans, decreasing the money supply. An increase in the discount rate discourages banks from borrowing and reducing the number of available loans, decreasing the money supply. In contrast, lowering the discount rate encourages member banks to borrow money and increases the funds they have available for loans, which is supposed to increase the money supply. Due to the Great Recession for 7 years from 2008 to 2015, the Fed lowered the discount rate to almost zero, hoping to increase bank lending. In 2015, the Fed gradually raised rates until the economic crisis caused by the COVID-19 pandemic again caused the Fed to reduce rates. Then the rise of inflation in 2023 caused the Fed to increase interest rates in an attempt to slow down the economy. As you can see, the Federal Reserve needs to adjust its discount rate policy to fit the different economic challenges it faces. The discount rate is one of two interest rates the Fed controls. The other is the rate banks charge each other, called the federal funds rate, which is the interest rate financial institutions charge when they lend to other financial institutions overnight. The Federal Reserve's check clearing role. If you write a check to a local retailer that uses the same bank you do, it is a simple matter to reduce your account by the amount of the check and increase the amount in the retailer's account. But what happens if you write a check to a retailer in another state? That's where the Fed's check clearing function comes into play. That retailer will take the check to its bank. That bank will deposit the check for credit in the closest Federal Reserve Bank. That bank will send the check to your local Federal Reserve Bank for the collection. The check will then be sent to your bank, and the amount of the check will be withdrawn. Your bank will authorize the Federal Reserve Bank in your area to deduct the amount of the check. That bank will pay the Federal Reserve Bank that began the process in the first place. It will then credit the deposit account in the bank where the retailer has its account. That bank will then credit the account of the retailer. See Figure 20.3 for a diagram of such an interstate transaction. This long and involved process is a costly one for the Fed. Therefore, banks have taken many measures to lessen the use of checks. Such efforts include the use of credit cards, debit cards, and other electronic transfers of money. Page 540, Figure 20.3. Check clearing process through the Federal Reserve Bank system. Suppose Mr. Brown, a farmer from Quince Orchard, Maryland, purchases a tractor from a dealer in Austin, Texas. Buyer, farmer in Quince Orchard, Maryland, to a seller, a tractor dealer in Austin, Texas, to a local bank in Austin, to the Federal Reserve Bank of Dallas, to Federal Reserve Bank of Richmond, to local bank in Quince Orchard, and then back to the Federal Reserve Bank of Richmond, and then back to Federal Reserve Bank of Dallas, and then back to the local bank in Austin, and then back to the seller, a tractor dealer in Austin, Texas. 1. Mr. Brown sends his check to the tractor dealer. 2. The dealer deposits the check in his account at a local bank in Austin. 3. The Austin bank deposits the check for credit in its account at the Federal Reserve Bank of Dallas. 4. the Federal Reserve Bank of Dallas sends the check to the Federal Reserve Bank of Richmond for collection. 5. The Federal Reserve Bank of Richmond forwards the check to the local bank in Quince Orchard, where Mr. Brown has his account. 6. The local bank in Quince Orchard deducts the check amount from Mr. Brown's account. 7. The Quince Orchard Bank authorizes the Federal Reserve Bank of Richmond to deduct the check amount from its deposit account with the Federal Reserve Bank. 8. The Federal Reserve Bank of Richmond pays the Federal Reserve Bank of Dallas. 9. The Federal Reserve Bank of Dallas credits the Austin Bank's deposit account. 10. The Austin Bank credits the tractor dealer's account. As you can see, the whole economy is affected by the Federal Reserve System's actions. Next, we'll briefly discuss the history of banking to give you some background about why the Fed came into existence about 100 years ago. Then we'll explore what's happening in banking today. Test prep. What is money? What are the 5 characteristics of useful money? What is the money supply and why is it important? How does the Federal Reserve control the money supply? What are the major functions of the Federal Reserve? What other functions does it perform? Page 541, The History of Banking and the Need for the Fed. LO 20-3, Trace the History of Banking and the Federal Reserve System. There was a time when there was no banks in the United States. Strict laws in Europe limited the number of coins people could bring to the colonies in the world. Thus, colonists were forced to barter for goods. For example, they might trade cotton and tobacco for shoes and lumber. The demand for money was so great that the Massachusetts issued its own paper money in 1690, and other colonies soon followed suit. But continental money, the first paper money printed in the United States, became worthless after a few years because people didn't trust its value. Land banks were established to lend money to farmers, but Great Britain, still in charge of the colonies at that point, ended land banks by 1741. The colonies rebelled against these and other restrictions on their freedom, and a new bank was formed in Pennsylvania during the American Revolution to finance the war against England. In 1791, after the United States gained independence, Alexander Hamilton persuaded Congress to form a central bank, a bank at which other banks could keep their funds and borrow funds if needed. The first version of a federal bank closed in 1811, only to be replaced in 1816 because state-chartered banks couldn't support the War of 1812. The battle between the Second Central Bank of the United States and state banks got hot in the 1830s. Several banks in Tennessee were hurt by pressure from the central bank. The fight ended when the central bank was closed in 1836. You can see that there was great resistance to a central bank like the Federal Reserve through much of U.S. history. By the time of the Civil War, the U.S. banking system was a mess. Different banks issued different kinds of currencies. People hoarded gold and silver coins because they were worth more as precious metals than as money. In any case, the chaos continued long after the war ended, reaching something of a climax in 1907. When many banks failed, people got nervous about the safety of banks and, in a run on the banks, attempted to withdraw their funds. Soon the cash was depleted and some banks had to refuse money to depositors. This caused people to distrust the banking system in general. Despite the long history of opposition to a central bank, the cash shortage problems of 1907 led to the Despite the long history of opposition to a central bank, the cash shortage problems of 1907 led to the formation of an organization that could lend money to banks, the Federal Reserve System. It was to be a lender of last resort in such emergencies. Under the Federal Reserve Act of 1913, all federally chartered banks had to join the Federal Reserve. State banks could also join. The Federal Reserve became the banker's bank. If banks had If banks had excess funds, they could deposit them in the Fed. If they needed extra money, they could borrow from the Fed. The Federal Reserve System has been intimately related to banking ever since, a link that has certainly grown in recent years. Bettman and Getty Images. The Federal Reserve System was designed in 1913 to prevent the kind of run on banks that had occurred in 1907. Yet the stock market crash of 1929 caused depositors to make another run on their banks and take big Yet the stock market crash of 1929 caused depositors to make another run on their banks and take big withdrawals. Federal Deposit Insurance was established in 1933 to protect depositors' money. Do you think that these protections are enough? Page 542. Adapting to change, how 40 years of Silicon Valley Bank ended in 48 hours. Silicon Valley Bank, SVB, was founded in 1983 and quickly grew to be the 16th largest bank in the United States. It specialized in financing and banking for venture capital-backed startup companies, mostly in the technology sector. Based in Silicon Valley, SVB had assets over $200. Based in Silicon Valley, SVP had assets over $200 billion in 2022. According to the Federal Deposit Insurance Corporation, FDIC, SVB assisted with the financing of almost half of all U.S. venture-backed technology and healthcare companies. The bank was a preferred bank for these sectors since many traditional banks would not finance companies in these businesses due to their high risks. For 40 years, SVB grew and prospered until in just 48 hours on March 10, 2023, the bank collapsed. It became the largest bank failure in the United States since Washington Mutual failed during the financial crisis in 2008. What caused the failure of SVB? A short and simple explanation is SVB was subject to a classic run on the bank from investors. Other possible problems and shortcomings at the bank are still being investigated. SVB invested a large amount of its bank deposits in U.S. Treasuries and agency-backed mortgage securities. Unfortunately, when interest rates increase, bonds and Treasury values decrease. With the Federal Reserve raising interest rates, SVB's bonds and Treasury notes decreased rapidly in value. Increased borrowing costs due to the Fed's efforts to stop inflation also led many tech companies to decrease banking activities. These companies were major customers and clearly benefited SVB's operations. Venture capital also had stalled, forcing many of the bank's startup businesses to withdraw funds from the bank. In short, the bank was sitting on a mountain of decreasing bond values while facing rapidly increasing customer withdrawals. Noah Berger and AFP and Getty Images. Approximately 97% of the bank's deposits were uninsured by the federal government since the accounts were well over the $250,000 FDIC coverage limit. This made customers want to withdraw funds at the first sign of trouble. When SVB announced it had sold a large block of securities at a loss and intended to sell $2.25 billion in new stock to help build its cash reserves, a panic among venture capital firms took hold. The word spread rapidly to investors through social media to get their money out of the bank. As SVB's stock plummeted, regulators intervened and closed the bank and placed it in a receivership under the FDIC. Within 48 hours, SVB was no more. The FDIC estimated that the SVB failure cost nearly $20 billion. Sources: Gianna Smilik. Before collapse of Silicon Valley Bank, the Fed spotted big problems. The New York Times, NewYorkTimes.com, March 19th, 2023. Remisha Maruf and Allison Morrow. How does a bank collapse in 48 hours? A timeline of the SVB fall. CNN Business, CNN.com, March 13th, 2023. Danielle Gilbert, Todd C. Frankel, and Joseph Men. Silicon Valley Bank's risk model flashed red, so its executives changed it. The Washington Post, WashingtonPost.com, April 2nd, 2023. Austin Weinstein, $42 billion in one day. SVB Bank, run biggest in more than a decade. Fortune.com, March 11th, 2023. Banking and the Great Depression. The Federal Reserve System was designed to prevent it. The Federal Reserve System was designed to prevent a repeat of the 1907 panic. Nevertheless, the stock market crash of 1929 led to bank failures in the early 1930s. When the stock market began tumbling, people hurried to banks to withdraw cash. In spite of the Federal Reserve System, the banks ran out of money and states were forced to close them. President Franklin D. Roosevelt extended the period of bank closings in 1933 to gain time to come up with a solution to the problem. In 1933 and 1935, Congress passed legislation to strengthen the banking system. The most important move was to establish federal deposit insurance to further protect the public from bank failures. Still, bank failures happen. Depositors in Silicon Valley experienced a bank collapse in 2023 when Silicon Valley Bank SVB failed in 48 hours. See the Adapting to Change box. Page 543. As you can see, bank crises are nothing new. They often will occur during a recession. From 1945 to 2009, the United States experienced 11 recessions. The average duration was 10 months. The longest recession was the Great Recession, 2008 through 2009, which lasted 18 months. Now that you are familiar with the evolution of the Federal Reserve, let's turn our attention to U.S. banks. The U.S. banking system, LO 20-4, classify the various institutions in the U.S. banking system. The U.S. banking system consists of commercial banks, savings and loan associations, and credit unions. In addition, there are various financial organizations or non-banks that accept no deposits but offer many of the services of regular banks. Let's discuss the activities and services of each, starting with commercial banks. Commercial banks, the banks that are probably the most familiar to you are commercial banks. A commercial bank is a profit-seeking organization that receives deposits from individuals and businesses in the form of checking and savings accounts and uses these funds to make loans. It has two types of customers, depositors and borrowers, and is equally responsible to both. The commercial bank makes a profit by efficiently using depositors' funds as inputs on which it pays interests to invest in interest-bearing loans to other customers. If the revenue generated by loans exceeds the interest paid to depositors plus operating expenses, the bank makes a profit. Services provided by commercial banks. Individuals and businesses that deposit money in a checking account can write personal checks to pay for almost any purchase or transaction. The technical name for a checking account is a demand deposit because the money is available on demand from the depositor. Some banks impose a service charge for check writing privileges or demand a minimum deposit. They might also charge a small handling fee for each check written. For corporate depositors, the amount of the service charge often depends on the average daily balance in the checking account. For corporate depositors, the amount of the service charge often depends on the average daily balance in the checking account, the number of checks written, and the firm's credit rating and credit history. In the past, checking accounts paid no interest to depositors, but interest-bearing checking accounts are available today under certain conditions. Commercial banks also offer a variety of savings account options. A savings account is technically a time deposit because the bank can require prior notice before you make a withdrawal. It would be wise for you to compare online and neighborhood banks to find where your money can earn the most interest. Unfortunately, over the past several years, you wouldn't have earned much interest on a time deposit in any bank. A certificate of deposit (CD) is a time deposit savings account that earns interest to be delivered on the certificate's maturity date. The depositor agrees not to withdraw any of the funds until then. CDs are now available for periods of months to years. CDs, certificate of deposits, are now available for periods of months to years. Usually, the longer the period, the higher the interest rate. The interest rates also depend on economic conditions. At the present time, interest rates have rebounded but remain historically low. Commercial banks may also offer credit cards to credit-worthy customers, life insurance, inexpensive brokerage services, financial counseling, automatic payment of bills, safe deposit boxes, individual retirement accounts, IRAs, traveler's checks, trust departments, automated teller machines, ATMs, and overdraft checking account privileges. The latter means preferred customers can automatically get loans when they've written checks exceeding their account balance. Services to borrowers. Commercial banks offer a variety of services to individuals and corporations in need of a loan. Since banks want to manage their funds effectively, loan applicants are screened carefully to ensure that the loan plus interest will be paid back on time. Generally, loans are given on the basis of the recipient's credit worthiness. Clearly, banks failed to do that in the period leading up to the banking crisis in 2008, when banks made loans irrespective of the borrower's ability to repay the loan. We will discuss why that happened later in the chapter. The nearby Making Ethical Decisions box explores a situation that could cause an employee to consider going beyond the scope of their job. Page 544, Making Ethical Decisions, an open and shut option. You work at a large bank in the new accounts department where you open accounts for new customers. The bank has a policy that pays bonuses related to the number of new accounts opened. Your manager tells you that many of the accounts are for small depositors. He suggests that when opening a new savings account for customers, you add another account, such as a credit card, without them being aware of it. You know that opening an account without the approval of the customer is not proper, but you also know the person may never know who opened it. Anyway, your manager suggested it, and bonus money sounds good. What is your alternatives? What would you do? Is that the ethical thing to do? Today, banks are continually trying to improve services to mobile users, especially millennials and Gen Zers. Having lived in an online world their entire lives, these groups are very adept at mobile banking. They use technology to deposit checks, pay bills, track expenses, and transfer money. Millions of customers now make a deposit by taking a photo of their checks. Savings and Loan Associations, S&Ls. A savings and loan association, S&L, is a financial institution that accepts both savings and checking deposits and provides home mortgage loans. S&Ls are often known as thrift institutions because their original purpose, starting in 1831, was to promote consumer thrift and home ownership. To help them encourage home ownership, thrifts were permitted for many years to offer slightly higher interest rates on savings deposits than banks. Those rates attracted a large pool of funds, which S&Ls used to offer long-term fixed-rate mortgages. Between 1986 and 1995, nearly 1,300 S&Ls failed. Reasons for the failures included the inflation of the 1970s, deregulation, regulatory failure. Regulators allowed insolvent thrifts to stay open while their situations worsened, and fraud. Today, S&Ls no longer offer better rates than banks because of changes in government laws, and many S&Ls have become banks. According to the FDIC, there are now less than 700 savings and loan companies in the United States. Credit unions. Credit unions are nonprofit, member-owned financial cooperatives that offer the full variety of banking services to their members: interest-bearing checking accounts at relatively high rates, short-term loans at relatively low rates, financial counseling, life insurance policies, and a limited number of home mortgage loans. They are organized by government agencies, corporations, unions, and professional associations. Today, credit unions are growing in popularity. As nonprofit institutions, credit unions enjoy an exemption from federal income taxes. You might want to visit a local credit union to see whether you are eligible for membership, and then compare the rates to those at local banks. Credit unions often have fewer branches than banks and less access to ATMs and other services. It's best to determine what services you need and then compare those services to the same services offered by banks. It is good to know that the money in credit union accounts discussed later is also insured for $250,000 as it is in your local bank. Page 545. Other financial institutions. Non-banks. Non-banks are financial organizations that accept no deposits but offer many of the services provided by regular banks. Non-banks include life insurance policies, pension funds, brokerage firms, commercial finance companies, and corporate financial services. As competition between banks and non-banks has increased, the dividing line between them has become less apparent. This is equally true in Europe, where U.S. companies compete with European banks. The diversity of financial services and investment alternatives non-banks offer has led banks to expand their own services. In fact, many banks have merged with brokerage firms to offer full-service financial assistance. Life insurance companies provide financial protection for policyholders who periodically pay premiums. In addition, insurers invest the funds they receive from policyholders in corporate and government bonds. Today, insurance companies often provide long-term financing for real estate development projects. Pension funds are monies put aside by corporations, nonprofit organizations, or unions to help fund their members' financial needs when they retire. Contributions to pension funds are made by employees, employers, or both to generate additional income. Pension funds typically invest in low return but safe corporate stocks or other conservative investments such as government securities and corporate bonds. Many financial services organizations that provide retirement and health benefits such as TIAA are a major force in U.S. financial markets. They also lend money directly to corporations. Unfortunately, after the long period of low interest rates over the past several years, many pension funds have are having problems meeting the expectations of their members. Brokerage firms have traditionally offered investment services in stock exchanges in the United States and abroad. They have also made serious inroads into regular banks' domain by offering high-yield combination savings and checking accounts. In addition, they offer money market accounts with check writing privileges and allow investors to borrow using their securities as In addition, they offer money market accounts with check writing privileges and allow investors to borrow using their securities as collateral. Commercial and consumer finance companies sometimes offer short-term loans to those who cannot meet the credit requirements of regular banks, such as new businesses or who have exceeded their credit limit and need more funds. Be careful when borrowing from such institutions, however, because their interest rates can be quite high. Test prep. Why did the United States need Federal Reserve? Why did the United States need a Federal Reserve Bank? What are the differences among banks, savings and loan associations, and credit unions? What's the primary role of pension funds? What is a consumer finance company? The banking crisis of 2008 and how the government protects your money. LO 20-5 briefly trace the causes of the banking crisis of 2008 and explain how the government protects your funds during such crisis. In 2007 through 2008, the United States experienced a banking crisis that threatened to topple the entire economy. Who was responsible for the banking crisis? There is no simple answer. Some people believe the Federal Reserve was partly responsible because it kept the cost of borrowing so low that people were tempted to borrow more than they could afford to pay back. Others blame the U.S. Congress for pressuring banks, normally very risk-averse institutions, to make risky loans. The Community Reinvestment Act, for example, encouraged loans to families with questionable ability to repay. The intention was to create more affordable housing, thus prodding banks to lend to people with minimal assets. Page 546. Price reduced foreclosure. KLH 49 and E+ and Getty Images. The bursting of the house bubble in 2008 forced a sharp decline in home values. When homeowners discovered they owed more on their mortgages than their homes were worth, many stopped paying off their loans. As a result, the banks foreclosed on their houses. While home prices have since risen in many areas of the country, some areas have been slower to recover. How has the housing market fared in your hometown? Banks learned they could avoid much of the risk of the questionable loans by dividing up their portfolios of mortgages and selling the mortgage-backed securities, MBSs. Banks learned they could avoid much of the risk of the questionable loans by dividing up their portfolios of mortgages and selling the mortgage-backed securities, MBSs, to other banks and other organizations all over the world. These securities seemed quite safe because they were backed by the homes that were mortgaged. Government-sponsored enterprises, Fannie Mae and Freddie Mac, seemed to guarantee the value of MBSs. Banks then sold more and more of such seemingly safe securities, hoping to make lots of money. Some banks were even accused of pushing loans onto naive consumers. Meanwhile, the Federal Reserve and the Securities and Exchange Commission were accused of failing their regulatory duties by not issuing sufficient warnings. When the value of homes began to decline, people began defaulting on their loans, not paying them, and turned the properties back over to the banks. Almost 5 million households suffered through housing foreclosures when the housing bubble burst in 2008. Since the banks owned the mortgages on those homes, their profits declined dramatically, leading to a banking crisis and the need for the government and the Federal Reserve to help out the banks. The long-term effects of that process were felt heavily in the economy, especially by millennials. Millennials' home buying rates fell significantly from 2009 until 2019, when they accounted for more than half of home purchases. Millennial home buying continued at a rapid pace until inflation and Federal Reserve interest rate hikes increased mortgage rates, which forced many potential home buyers to delay home purchases. So whom do we blame for the banking crisis? The answer is that we could blame the Fed for suppressing interest rates, Congress for promoting questionable loans, the banks for making such loans and creating mortgage-backed securities that were not nearly as safe as promoted, government regulatory agencies for not doing their job, and people who took advantage of low interest rates to borrow money they couldn't. So whom do we blame for the banking crisis? The answer is that we could blame the Fed for the suppressing interest rates, Congress for promoting questionable loans, the banks for making such loans and creating mortgage-backed securities that were not nearly as safe as promoted, government regulatory agencies for not doing their job, and people who took advantage of low interest rates to borrow money they couldn't reasonably hope to repay. No matter who was to blame, it was a painful period and certainly one of the most serious for the U.S. economy. Protecting your funds. The banking crisis that occurred in 2007 through 2008 was hardly the first economic crisis the nation has faced. The economy suffered similar problems during the Great Depression of the 1930s, when many investors lost everything they had, to prevent investors from ever again being completely wiped out during an economic downturn. Congress created three major organizations to protect your money: the Federal Deposit Insurance Corporation (FDIC), the Deposit Insurance Fund (DIF), and the National Credit Union Administration (NCUA). All three insure deposits in individual accounts up to a certain amount. Because these organizations are so important to the safety of the money you have deposited, let's explore them individually in a bit more depth. The Federal Deposit Insurance Corporation (FDIC). The Federal Deposit Insurance Corporation (FDIC) is an independent agency of the U.S. government that insures bank deposits. If a bank were to fail, the FDIC could arrange to have that bank's accounts. If a bank were to fail, the FDIC could arrange to have that bank's accounts transferred to another bank or reimburse depositors up to $250,000 per account. This happened in 2023 when Silicon Valley Bank (SVB) became the second largest bank failure in U.S. history. The FDIC took control of the bank via a new entity it created called Deposit Insurance National Bank of Santa Clara. All deposits were transferred to the new bank. The FDIC covers many institutions, mostly commercial banks. Of course, one problem is that the government doesn't have unlimited money to cover all losses if too many banks should fail. Page 547, the Deposit Insurance Fund (DIF). The Deposit Insurance Fund (DIF) covers all deposits above the FDIC limits at member banks. The FDIC at the Federal Savings and Loan Insurance Corporation (FSLIC) were designed in 1933 and 1934 respectively to create more confidence in banking institutions by protecting people's savings from loss. To get more control over the banking system in general, the government placed the FSLIC under the FDIC and gave it a new name, the Savings Association Insurance Fund (SAIF). The National Credit Union Administration (NCUA). The National Credit Union Administration (NCUA) provides up to $250,000 of coverage per individual depositor per institution. This coverage includes all accounts, checking accounts, savings accounts, money market accounts, and certificates of deposit. Depositors qualify for additional protection by holding accounts jointly or in trust. Individual retirement accounts (IRAs) are also separately insured up to $250,000. Credit unions, like banks, suffered from the banking crisis of 2008 and needed money from the federal government to make more loans. Using technology to make banking more efficient. LO 20-6 Describe how technology helps make banking more efficient. Imagine the cost to a bank of approving a written check. Imagine the cost to a bank of approving a written check, physically processing it through the banking system and mailing it back to you. It's expensive. Bankers long looked for ways to make the system more efficient. One solution was to issue credit cards to reduce the flow of checks, but they too have their costs. There's still paper to process. Accepting credit cards costs retailers a bit over 2% of the amount charged. Will undoubtedly continue to see much more electronic rather than physical exchange of money because it is the most efficient way to transfer funds. In an electronic funds transfer (EFT) system, messages about a transaction are sent from one computer to another. Thus, organizations can transfer funds more quickly and economically than with paper checks. EFT tools include electronic check conversion deposit. EFT tools include electronic check conversion, debit cards, smart cards, direct deposits, and direct payments. A debit card serves the same function as a check. It withdraws funds from a checking account. When the sale is recorded, the debit card sends an electronic signal to the bank, automatically transferring funds from your account to the sellers. A record of transactions immediately appears online. Debit transactions surpassed credit years ago and continue to grow. Photo royalty and Shutterstock. RFID chips and credit cards allow consumers to pay for products with a wave of the hand, but they're also easier for hackers to access, requiring consumers to be vigilant about where they spend their money. How do you make sure that your identity and finances are secure? Payroll debit cards are an efficient way for some firms to pay their workers and are an alternative to cash for those who don't qualify for or want a credit or debit card. The so-called unbanked employees can access funds in their accounts immediately after they are posted, withdraw them from an ATM, pay bills online, or transfer funds to another card holder. The system is much cheaper for companies than issuing checks and more convenient for employees. On the other hand, debit cards don't offer the same protection as credit cards. If someone steals your credit card, you are liable only for a certain amount. You are liable for everything when someone steals your debit card. Page 548, a smart card is an electronic funds transfer tool that combines a credit card, debit card, phone card, driver's license card, and more. Smart cards replace the typical magnetic strip on a credit card. Smart cards replace the typical magnetic strip on a credit or debit card with a microprocessor. The card can then store a variety of information, including the holder's bank balance. Merchants can use this information to check the card's validity and spending limits. And transactions can debit up to the amount on the card. Some smart cards have embedded radio frequency identification (RFID) chips that make it possible to enter buildings and secure areas, and to buy gas and other items with a swipe of the card. A biometric function lets you use your fingerprint to boot up your computer. Students are using smart cards to open locked doors to dorms and identify themselves to retailers near campus and online. The cards also serve as ATM cards. For many, The ultimate convenience in banking is automatic transactions such as direct deposit and direct payments. A direct deposit is a credit made directly to a checking or savings account in place of a paycheck. The employer contacts the bank and orders it to transfer funds from the employer's account to the worker's account. Individuals can use direct deposits to transfer funds to other accounts, such as from a checking account to a savings or retirement account. A direct payment is a pre-authorized electronic payment. Customers sign a separate form for each company whose bill they would like to automatically pay from their checking or savings account on a specified date. Customers sign a separate form for each company whose bill they would like to automatically pay from their checking or savings account on a specified date. The customer's bank completes each transaction and records it on the customer's monthly statement. Online banking: almost all top U.S. retail banks allow customers to access their accounts online, and most have bill-paying capacity. Thus, you can complete all your financial transactions from home using your computer or mobile phone to transfer funds from one account to another, pay your bills, and check the balance in each of your accounts. You can apply for a car loan or mortgage and get a response while you wait. Buying and selling stocks and bonds is easily. Buying and selling stocks and bonds is equally easy. Online banks such as E-Trade Bank offer online banking only, not physical branches. They can offer customers slightly higher interest rates and lower fees because they do not have the overhead costs traditional banks have. While many consumers are pleased with the savings and convenience, not all are happy with the service. Why? Some are nervous about security. People fear putting their financial information into cyberspace, where others may see it despite all the assurances of privacy. International Banking and Banking Service, LO 20-7, evaluate the role and importance of international banking. The World Bank and the International Monetary Fund. Banks help companies conduct business in other countries by providing three services: letters of credit, bankers' acceptances, and money exchange. If a U.S. company wants to buy a product from Germany, the company could pay a bank to issue a letter of credit. A letter of credit is a promise by the bank to pay the seller a given amount if certain conditions are met. For example, the German company may not be paid until the goods have arrived at the U.S. company's warehouse. A banker's acceptance promises that the bank will pay some specified amount at a particular time. No conditions are imposed. Finally, a company can go to a bank and exchange U.S. dollars for euros to use in Germany. That's called currency exchange or money exchange. Page 549, banks have made buying goods and services globally easy for travelers and business people. For example, ATMs now provide yen, euros, and other foreign currencies through your personal Visa, MasterCard, Cirrus, or American Express card. Leaders in international banking. It would be short-sighted to discuss the U.S. economy apart from the world economy. If the Federal Reserve decides to lower interest rates, within minutes, foreign investors can withdraw their money from the United States and put it in countries with higher rates. Of course, the Fed's increasing of interest rates can draw money to the United States quickly. Equally quickly. Today, money markets thus form a global market system of which the United States is just a part. International bankers make investments in any country where they can get a maximum return for their money at a reasonable risk. About $6.6 trillion is traded daily. The net result of international banking and finance has been to link the economies of the world into one interrelated system with no regulatory control. U.S. firms must compete for funds with firms all over the world. An efficient firm in London or Tokyo is more likely to get international financing than a less efficient firm in Detroit or Chicago. Global markets mean that banks do not necessarily keep their money in their own countries. They make investments where they get the maximum return for a reasonable or acceptable risk. What this means for you is that banking is no longer a domestic issue, it's a global one. To understand the US financial system, you must learn about the global financial system, including foreign central banks. To understand the state of the U.S. economy, you need to learn about the economic condition of countries throughout the world. In the world economy financed by international banks, the United States is a major player, but just one player. To continue being the global leader, the United States must stay financially secure, and its businesses must stay competitive in world markets. The World Bank and the International Monetary Fund. The bank primarily responsible for financial economic development is the International Bank for Reconstruction and Development, or the World Bank. After World War II, it lent money to countries in Western Europe so they could rebuild. Today, it lends most of its money to less developed nations to improve their productivity and help raise standards of living and quality of life. That includes working to eliminate diseases that kill millions of people each year, income inequality, and rampant inflation throughout those nations. Francis Chung and E&E News and Politico and AP Images. The World Bank and International Monetary Fund, IMF, are intergovernmental organizations that help support the global banking community. Both draw protests for their actions. Why? Page 550, the World Bank has faced considerable criticism and protests around the world. Environmentalists charge that it finances projects that are damaging to the ecosystem. Human rights activists and unionists say the bank supports countries that restrict religious freedoms and tolerate sweatshops. AIDS activists have complained that it does not do enough to get low-cost AIDS drugs to less developed. Others felt many of these countries did not get needed attention during the COVID-19 crisis, despite its efforts to improve its image. The World Bank still has many critics. Some wanted to forgive the debts of less developed countries, and others wanted to stop making such loans until the countries institute free markets and the right to own property. Some changes in World Bank policy may need to be considered. In contrast to the World Bank, the International Monetary Fund, IMF, was established to foster cooperative monetary policies that stabilize the exchange of one national currency for another. About 190 countries are voluntary members of the IMF and allow their money to be freely exchanged for foreign money. Keep the IMF informed about changes in monetary policy and modify those policies on the advice of the IMF to accommodate the needs of the entire membership. The IMF is designed to oversee member countries' monetary and exchange rate policies. Its goal is to maintain a global monetary system that works best for all nations and enhances world trade. While it is not primarily a lending institution like the World Bank, its members do contribute funds according to their ability, and those funds are available to countries in financial difficulty. Test prep. Why are some of the causes for the banking crisis that began? What are some of the causes for the banking crisis that began in 2008? What is the role of the FDIC? How does a debit card differ from a credit card? What is the World Bank and what does it do? What is the IMF and what does it do? Summary LO 20-1. Explain what money is and what makes money useful. What is money? Money is anything people generally accept as payment for goods and services. What are the 5 standards for a useful form of money? The 5 standards for a useful form of money are portability, divisibility, stability, durability, and uniqueness. What is Bitcoin, and can you buy things online with it? Bitcoin is a form of online money. Bitcoin has an online store that accepts the currency. LO 20-2. Describe how the Federal Reserve controls the money supply. How does the Federal Reserve control the money supply? The Federal Reserve makes financial institutions keep funds in the Federal Reserve System. Reserve requirement buys and sells government securities, open market operation, and lends money to banks. The discount rate. To increase the money supply, the Fed can cut the reserve requirement, buy government bonds, and lower the discount rate. Page 551, LO 20-3. Trace the history of banking and the Federal Reserve System. How did banking evolve in the United States? Massachusetts issued its own paper money in 1690. Other colonies followed suit. British land banks lent money to farmers but ended such loans by 1741. After the American Revolution, there was much debate about the role of banking and heated battles between the Central Bank of the United States and state banks. Eventually, a federally chartered and state-chartered system was established, but chaos continued until many banks failed in 1907. The system was revived by the Federal Reserve, only to fail again during the Great Depression. There have been 11 recessions since then, including a major one in 2008. LO 20-4. Classify the various institutions in the U.S. banking system. What institutions make up the banking system? Commercial banks, savings and loans, and credit unions are all part of the banking system. How do they differ from one another? Before deregulation in 1980, commercial banks were unique in that they handled deposits for both checking and savings accounts. At that time, savings and loans couldn't offer checking services. Their main function was to encourage thrift and home ownership by offering high interest rates on savings accounts and providing home mortgages. Deregulation closed the gaps between banks and S&Ls, and they now offer similar services. What kinds of services do they offer? Banks and S&Ls offer such services as savings accounts, checking accounts, certificates of deposit, loans, individual retirement accounts, IRAs, safe deposit boxes, online banking, life insurance, brokerage services, and traveler's checks. What is a credit union? A credit union is a member-owned cooperative that offers everything a bank does. It takes deposits, allows you to write checks, and makes loans. It also may sell life insurance and offer mortgages. Credit union interest rates are sometimes higher than those from banks, and loan rates are often lower. What are some of the other financial institutions that make loans and perform bank-like operations? Non-banks include life insurance companies that lend out their funds, pension funds. Non-banks include life insurance companies that lend out their funds, pension funds that invest in stocks and bonds and make loans, brokerage firms that offer investment services, and commercial finance companies. LO 20-5 briefly traced the causes of the banking crisis of 2008 and explain how the government protects your funds during such crises. What caused the banking crisis? The goal was to have affordable housing, so the government urged banks to make loans to borrowers who could not afford to repay. The banks wanted to minimize the risk of such loans, so they created mortgage-backed securities and sold them to other banks and organizations throughout the world. The government did not regulate these transactions well, and many banks failed because housing values fell and people defaulted on their loans. Many have been blamed for the loss. The Fed, Congress, Many have been blamed for the loss. The Fed, Congress, bank managers, Fannie Mae, and Freddie Mac among them. What agencies ensure the money you put into a bank or credit union? What agencies insure the money you put into a bank or credit union? Money up to $250,000 deposited in banks is insured by the Federal Deposit Insurance Corporation, FDIC. The Deposit Insurance Fund, DIF, insures money above the $250,000 FDIC limit. Money in credit unions is insured by the National Credit Union Administration, NCUA, up to $250,000. Page 552, LO 20-6. Describe how technology helps make banking more efficient. What are debit cards and smart cards? A debit card looks like a credit card, but withdraws money that is already in your account. When the sale is recorded, the debit card sends an electronic signal to the bank, automatically transferring funds from your account to the sellers. A smart card is an electronic funds transfer tool that combines a credit card, debit card, phone card, driver's license card, and more. Smart cards replace the typical magnetic strip on a credit or debit card with a microprocessor. What is the benefits of automatic transactions and online banking? A direct deposit is a credit made directly to a checking or savings account in place of a paycheck. A direct payment is pre-authorized electronic payment. Customers sign a separate form for each company whose bill they would like to automatically pay from their checking or savings account on a specified date. The customer's bank completes each transaction and records it on the customer's monthly statement. All top U.S. retail banks now allow customers to access their accounts online, and most have bill-paying capacity. LO 20-7. Evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. What do we mean by global markets? Global markets mean that banks do not necessarily keep their money in their own countries. They make investments where they get the maximum return. What this means for you is that banking is no longer a domestic issue, it's a global one. What roles do the World Bank and the IMF play? The World Bank, also called the International Bank for Reconstruction and Development, is primarily responsible for financing economic development. The International Monetary Fund, IMF, in contrast, was established to assist the smooth flow of money among nations. It requires members who join voluntarily to allow their own money to be exchanged for foreign money freely, to keep the IMF informed about changes in monetary policy, and to modify those policies on the advice of the IMF to accommodate the needs of the entire membership. Key terms: banker's acceptance, barter, certificate of deposit, CD, commercial bank, credit unions, debit card, deposit insurance fund, DIF, demand deposit, discount rate, electronic funds transfer EFT system, Federal Deposit Insurance Corporation FDIC, International Monetary Fund IMF letter of credit, M-1, M-2, M-3, money supply, non-banks, open market operations, pension funds, reserve requirement, savings and loan association, SNL, smart card, time deposit, World Bank. Critical thinking. 1. If you were chairperson of the Federal Reserve, what economic figures might you use to determine how well you were doing? What role did the Federal Reserve play in the banking crisis of 2008 through 2009? 2. How much cash do you usually carry with you? What other means do you use to pay for items at the store or on the internet? What trends do you see in such payments? How might those trends make your purchase experience more satisfactory? 3. If the value of the dollar declines relative to the euro, what will happen to the price of French wine sold in U.S. stores? Will people in France be more or less likely to buy a U.S.-made car? Why? 4. Do you keep your savings in a bank, an SNL, a credit union, or some combination? Have you compared the benefits you could receive from each? Where would you expect to find the best loan values? 5. In what ways did the COVID-19 pandemic impact the economy? How did the Federal Reserve deal with the economic crisis caused by COVID-19? Were the Fed's actions successful in addressing the economic situation? Page 553, Putting Principles to Work. Purpose: to learn more about the banking crisis that began the Great Recession and what was happened. To learn more about the banking crisis that began the Great Recession and what has happened since. Exercise: the banking crisis in 2008 was one of the most serious events ever in the U.S. economic history. The banking crisis in 2008 was one of the most serious events ever in U.S. economic history. 1. Search online for articles about the causes of the banking crisis that began in 2008. See if anyone in the class knows someone who has directly affected. See if anyone in the class knows someone who was directly affected by the banking crisis, i.e., important example, lost their home. What organizations share the blame for the crisis? What do you think deserves the blame? 2. Search for information about what has happened to banking in the United States and around the world since the banking crisis. What role did the Fed play in ending the crisis in the United States? 3. Search for information about new banking regulations or changes the current president and Congress have proposed or passed. Do you think these changes will help the banking system and help prevent another financial disaster such as the 2008 crisis? Developing career skills, key, team analytic communication technology. 1. In a small group, discuss the following. What services do you use from banks and SNLs? How many of you use online banking? What seem to be its pluses and minuses? Use this opportunity to go online to compare the rates and services of various local banks and SNLs. 2. Poll the class to see who uses a bank and who uses a credit union. Have class members compare the services at each, interest rates on savings accounts, services available, loan rates. If anyone uses an online service, see how those rates compare. If no one uses a credit union or online bank, discuss the reasons why. 3. One of the key roles of the Federal Reserve is to monitor and adjust interest rates when necessary. to keep the economy functioning efficiently. If the Fed raises interest rates to battle inflation, how might that action affect market sectors such as real estate and automobile? 4. Form several smaller groups to research and discuss the banking crisis of 2008 through 2009. Did it affect anyone in the class or anyone you know? What has happened to banks and the economy in general since the banking crisis? 5. Write a one-page paper on the role of the World Bank and the International Monetary Fund in providing loans to less developed countries. Should the United States lend money to other countries through such organizations? Why or why not? Be prepared to debate the value of these organizations in class. Career exploration. If you are interested in pursuing a career in the banking industry, here are a few to consider. Find out about the tasks performed, skills needed, pay, and opportunity outlook in these fields in the Occupational Outlook Handbook OOH at bls.gov. Loan officer evaluates, authorizes, or recommends approval of loan applications for people and businesses. Foreign exchange trader focuses on foreign currency exchange markets, reviews the various factors that influence local rates of exchange and decides which currencies to buy and sell in the foreign exchange markets. Credit counselor advises individuals and businesses about loans, financial goals, and debt, recommends different types of loans and payment plans to help with debt payment. Credit counselor advises individuals and businesses about loans, financial goals, and debt, recommends different types of loans and payment plans to help with debt repayment. Video case McGraw-Hill Connect, Understanding the Federal Reserve System. McGraw-Hill. The Federal Reserve, also called the Fed, is the central bank of the United States. The Fed oversees the currency and money supply. The Federal Reserve System consists of 5 major parts. 1. The Board of Governors. 2. The Federal Open Market Committee. 3. 12 Federal Reserve Banks. 4. 3 advisory councils. And 5. The 3,000 member banks in the system. The Board of Governors administers and supervises the 12 Federal Reserve Banks. The 7 members of the board are appointed by the President of the United States and confirmed by the United States Senate. The Federal Open Market Committee has 12 voting members and is the policy-making body. The Federal Reserve is a private firm not supported by taxpayer dollars. The Fed buys and sells foreign currencies, regulates various types of credit, supervises banks, and collects data on the money supply and other economic activity. The Fed's action directly affect everyone in terms of credit card rates, consumer prices, and student loan rates. The Fed uses three processes for controlling the money supply that impact the economy: the reserve requirement, open market operations, and the discount rate. The reserve requirement is a percentage of the money in commercial banks, checking and savings accounts that must be kept in the bank or in a non-interest bearing deposit at the local Federal Reserve Bank. If a bank has $100 million in deposits and the reserve requirement is 10%, the bank must have $10 million on reserve. The Fed also conducts open market operations that involve the buying and selling of government bonds. There are a finite number of bonds available in the economy. If the Fed sells bonds, the money required for them is longer in circulation, which decreases the money supply. The opposite occurs if the Fed is buying bonds. The money the Fed pays to buy the bonds is back in circulation, which increases the money supply. The Fed Reserve is often referred to as the banker's bank because member banks can borrow money from the Fed and lend it out to customers in the form of loans. The discount rate is the interest rate the Fed charges for loans to member banks. If the rate goes up, banks don't borrow, resulting in less money being available for loans to businesses and consumers. The Fed also acts as a clearinghouse in the banking system. The Fed clears transactions such as check cashing. The Fed sends payments back and forth among banks as the head of the automatic clearinghouse network. The Fed also assumes the key role of managing the unemployment rate by keeping inflation at a level it deems acceptable. The Fed becomes extremely important during difficult economic times such as the Great Recession, when unemployment accelerated and the Fed lowered the interest rate to almost zero, hoping to encourage bank lending. The entire economy is affected by the actions of the Federal Reserve. A simple piece of advice is to pay attention to the Fed and follow what it is doing. A simple piece of advice is to pay attention to the Fed and follow what it is doing. Thinking it over: 1. Describe how the Federal Reserve can use its authority to stimulate the economy. 2. How does the Fed raising the reserve requirement affect the possibility of getting a business loan? 3. Why is monetary policy an important part of the Federal Reserve mission? Page 555, page 556. Notes. Bonus Chapter A, Working Within the Legal Environment, page 557. Learning objectives. After you have read and studied this bonus chapter, you should be able to A1. Define business law, distinguish between statutory and common law, and explain the role of administrative agencies. Define tort law and explain the role of product liability in tort law. Identify the purposes and conditions of patents, copyrights, and trademarks. Describe warranties and negotiable instruments as covered in the Uniform Commercial Code. List and describe the conditions necessary to make a legally enforceable contract, and describe the possible consequences if such a contract is violated. Summarize several laws that regulate competition and protect consumers in the United States. Explain the role of tax laws in generating income for the government and as a method of discouraging or encouraging certain behaviors among taxpayers. Distinguish among the various types of bankruptcy as outlined by the Bankruptcy Code. Explain the role of deregulation as a tool to encourage competition. Page 558. Getting to know Scott Boras, baseball attorney.